The yield magnet, how U.S. Treasuries are pulling global credit into their orbit. Section 1, Introduction. The global monetary system is undergoing a quiet, structural realignment, one that isn't being announced by central banks, but is instead being encoded into regulation, stablecoin architecture, and institutional behavior. At the center of this shift lies the unassuming U.S. Treasury bill, a short-term debt instrument once considered too boring to matter to grand strategy, now becoming the gravitational core around which new forms of credit are expanding across borders. The trigger? A new regulatory framework in the United States, the Genius Act, which grants legal form to a growing digital shadow system, stablecoins backed by U.S. Treasury bills. This technical allowance, while seemingly minor, sets in motion a deeper dynamic: the transformation of U.S. sovereign debt into programmable, yield-bearing infrastructure for both domestic and foreign institutions. Foreign banks and non-U.S. issuers, long operating in the shadowy Eurodollar system, are now eyeing this development as a gateway. If they can find structured access to U.S. Treasury yield, even indirectly, they can expand local credit, pocket the yield, and remain compliant under emerging global rules. The result is a new form of capital gravity. Credit expands abroad, but the yield magnet remains in Washington. Yet gold remains the great counterweight, a non-yielding, non-censorable, non-sanctionable form of wealth that continues to quietly appreciate as inflation erodes fiat-based returns. As treasuries and gold take their places on opposite ends of the reserve asset spectrum, the world must decide: is engineered yield worth the price of permissioned access, or is silent sovereignty the better store of value? This exposition explores how we got here, what the new infrastructure looks like, and what this means for the global financial system, sovereign strategy, and the future of money itself. Section 2, the regulatory unlock. The passage of the Genius Act, short for Guaranteeing Essential New Infrastructure for Ubiquitous Stablecoins, marked a quiet turning point in U.S. monetary policy, not because it changed interest rates or unleashed fiscal stimulus, but because it gave legal form to a growing digital shadow system, stablecoins backed by U.S. Treasury bills. Under the Act, U.S. dollar-denominated payment stablecoins must be backed one-to-one by permitted reserve assets. These assets include U.S. currency and demand deposits, reverse repos with the Federal Reserve, and crucially, short-term U.S. Treasuries with maturities of 93 days or less. The effect of this legal change is profound. It means that U.S. sovereign debt has been officially anointed as the foundational collateral for programmable dollars. Not only that, the law also prohibits stablecoin issuers from paying interest directly to holders. In other words, the issuer keeps the yield. This changes the economic model for stablecoins. The user gets price stability and liquidity. The issuer captures the spread, the yield on Treasury bills. The regulator gains visibility and control over the system. In traditional banking, the spread between deposits and loans drives profits. Under this model, the spread exists between 0% yielding stablecoins and approximately 5% yielding U.S. Treasury bills. For large regulated issuers, this is free cash flow in disguise and an attractive incentive to scale issuance rapidly. But this model doesn't just apply domestically. Foreign banks, offshore institutions, and Eurodollar operators now see an opportunity. If they can get structured access to this same Treasury bill yield, whether by issuing stablecoins, lending U.S. dollars, or backing credit with short-term treasuries, they too can tap the engine. Thus, what began as a compliance framework for digital dollars has become a yield-hunting blueprint for institutional actors worldwide. The magnet is in motion. Section 3, Eurodollar gravity. Long before stablecoins entered the conversation, the Eurodollar system quietly redefined the global financial order. These were U.S. dollars held and circulated outside of U.S. regulatory reach, in foreign banks, beyond the jurisdiction of the Federal Reserve. Despite the name, Eurodollars have nothing to do with the euro currency. They emerged in post-war Europe and expanded globally as a workaround to capital controls and domestic banking regulations. For decades, Eurodollars functioned as a parallel monetary universe, credit denominated in dollars, but not created by U.S. banks. The system enabled foreign institutions to lend, settle, and transact in U.S. dollars without ever touching a Fed window. This was the first time the dollar was truly sovereign agnostic, used by countries that didn't answer to Washington. But the Eurodollar system came with a trade-off. No access to the Fed meant no access to official dollar liquidity in times of crisis. That's why, during major financial shocks from 2008 to 2020, foreign banks begged for swap lines, lifelines to the Fed's balance sheet, brokered through their own central banks. These swap lines were the emergency airlocks to the real monetary center. Now, with the Genius Act and stablecoin regulation in place, a new gravity well is forming: U.S. Treasury bills. Whereas Eurodollar credit once floated freely, today's environment is being shaped by the need for regulatory compliance, the demand for secure yield, and the rise of tokenized and regulated dollar instruments. Foreign institutions are adapting. Instead of relying solely on offshore dollar liquidity, they are incentivized to migrate their capital into structures that give them access to U.S. sovereign yield and regulatory legitimacy, even if indirectly. This is Eurodollar gravity in reverse. Offshore liquidity is being pulled inward toward the yield at the core of the U.S. financial system. The Treasury bill, once just a safe asset, is now a yield-bearing oracle, the foundation for programmable dollars, digital collateralization, and global institutional strategy. And while this shift seems technical, its implications are profound. It means that the U.S. no longer needs to export treasuries. The world is now reaching inward to hold them. The center of credit issuance may remain global, but the center of yield has become unmistakably American. Section 4. Infrastructure of access. If U.S. Treasury bills are becoming the gravitational center of global yield, the next logical question is, how do foreign banks and institutions actually reach the magnet? They don't have direct access to the Federal Reserve, they don't operate under U.S. charters, and yet they're getting closer to the Fed's yield engine than ever before. The secret lies in the architecture of intermediated access, a web of regulatory proxies, institutional plumbing, and derivative instruments that enables global actors to tap into U.S. sovereign yield without ever setting foot inside Washington. First, swap lines. The most well-known access route is the central bank swap line. In times of crisis, the Federal Reserve opens temporary or permanent swap lines with a select group of trusted central banks: the European Central Bank, the Bank of Japan, the Bank of England, the Bank of Canada, and a few others. Here's how it works. The foreign central bank swaps its local currency for U.S. dollars at a fixed rate with the Fed. It then lends those dollars to its domestic banks. These banks can use the dollar liquidity to meet obligations, unwind trades, or even, if structured properly, invest in U.S. Treasuries. While swap lines are typically used to stabilize funding markets, they also give foreign institutions temporary access to dollar liquidity, which can be routed toward short-term sovereign yield under the right circumstances. But swap lines are exclusive. Most countries don't have them, and even for those that do, they're contingent, political, and short-lived. Second, proxy access via U.S. banks with Fed master accounts. This is the more durable form of access. Foreign banks can open accounts or relationships with U.S. banks that participate directly in Fed markets. They can use these banks as custodians, allowing them to hold Treasury bills and other dollar-denominated assets in trust. They can issue stablecoins or credit instruments backed by these reserves, structured to meet compliance thresholds in both jurisdictions. This creates a two-layer system. The Fed interacts with regulated U.S. banks. The U.S. banks interact with foreign institutions, who in turn interact with local borrowers and depositors. As long as regulatory, capital, and anti-money laundering rules are met, this structure allows a foreign institution to lend in local currency, invest in dollar assets, and profit from the spread, all without violating legal constraints. Third, currency hedging and synthetic carry trades. To make the system work across currencies, institutions employ currency hedging instruments, particularly cross-currency basis swaps. These allow a bank to borrow in a low-interest currency, such as yen or euro, swap that liability into dollars, invest the dollars in high-yielding U.S. Treasuries, and lock in the spread via the swap. This is the core of the carry trade, and when executed through regulated, compliant channels, it becomes a yield-farming mechanism for the institutional class. Even without physical dollars, a bank can synthetically replicate the effect of holding treasuries by using derivatives, futures, swaps, and repos, all tied to Treasury bill yields. Fourth, the rise of Treasury-backed stablecoins. The emergence of Treasury-backed stablecoins, such as those proposed under the Genius Act, offers a third, more scalable pathway. These tokens are issued by regulated entities. They are fully backed by short-term U.S. Treasuries. They provide on-chain liquidity and redemption. And they offer programmable access to sovereign yield, even if yield isn't passed to holders. For foreign banks with digital infrastructure and stablecoin integration, this represents a new form of dollar access, one that blends regulatory compliance with technological flexibility. In effect, stablecoins are becoming permissioned access points to the U.S. Treasury market. This infrastructure, swap lines, proxy banks, synthetic hedging, and stablecoins, is how the gravity of Treasury bill yield reaches beyond U.S. borders. It forms a layered system of pipes and valves, controlling who gets access, under what terms, and at what cost. And for those with access, the prize is enormous: leveraged local lending, funded by the sovereign yield of the world's most powerful central bank. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. Strategic Implications. The infrastructure now in place, regulatory clarity via the Genius Act, yield access through proxy institutions, and synthetic replication via stablecoins and swaps, all serve a singular outcome: the reconsolidation of the U.S. dollar's dominance, not through force but through gravity. This isn't Bretton Woods version 2. It's subtler, it's programmable, and it's far more entangled. The United States doesn't need to impose dollar dominance. It simply makes access to yield irresistible and selectively permits it. First, short-term treasuries become global liquidity anchors. Historically, long-term treasuries served as the world's risk-free benchmark, the ultimate store of sovereign-backed value. But today, the short end of the curve, Treasury bills under 1 year, is taking on a new strategic function. They are highly liquid, allowing near-instant redemption and settlement. They are accepted collateral in repo markets and interbank lending. They now serve as backing for regulated stablecoins. And they offer non-trivial yield, over 5% in many maturities as of 2025. This makes short-term treasuries not just cash equivalents, but reserve assets with real return. As foreign institutions structure around these assets, their own credit creation becomes functionally tied to the U.S. yield curve. The result? Global credit expansion is increasingly collateralized by U.S. sovereign debt. Second, artificial demand and engineered liquidity. In traditional markets, demand for treasuries was driven by a mix of safety, regulatory compliance, such as Basel capital rules, and diversification. But now, the demand is being engineered through stablecoin frameworks that require treasury bill backing, institutional strategies that park excess liquidity in short-term treasuries, and FX carry trades that cycle global liquidity through U.S. debt instruments. This creates a virtuous loop, or a trap, depending on perspective. More credit creation abroad leads to more demand for treasury bills. That pushes yields lower, which creates more incentive to back reserves with them, which creates more pressure to keep the loop going. The U.S. gains from this dynamic: lower funding costs for its government, increased dependency of global banks on U.S. financial rails, and a quietly re-centralized monetary architecture, even in a fragmented geopolitical world. Third, financial fragility in the shadow. But there are cracks beneath the surface. Liquidity mismatches, foreign banks lending in local currencies but funding in U.S. dollars or synthetic U.S. dollars expose themselves to currency risk. A shock in FX markets or swap basis volatility can trigger sudden unwinds, as seen during past carry trade collapses. Selective access. Swap lines are not universal. Institutions without access are forced to rely on expensive or fragile intermediaries, introducing political risk into what was once a neutral system. Overconcentration. If too much of global liquidity depends on short-term treasury bills, any disruption in U.S. monetary policy or debt issuance could ripple worldwide. What looks like safe yield today could become a transmission channel for global shocks tomorrow. Fourth, strategic dependency versus sovereign autonomy. Ultimately, the countries and institutions building credit systems around U.S. Treasury bills are surrendering monetary sovereignty in exchange for stability and yield. But unlike past eras, this isn't enforced at gunpoint or through IMF lending conditions. It's achieved through voluntary adoption of stablecoin regulation, financial self-interest, and the illusion of neutrality in programmable money. The real prize isn't the yield, it's the influence. He who controls the collateral controls the credit, and increasingly, that collateral is made in America. Section 6. Gold as the silent counterforce. While the U.S. Treasury yield engine tightens its grip on the global financial system, another force continues to move, not loudly, but deliberately. That force is gold, no yield, no central counterparty, no compliance requirements, no swap lines, no permission needed. And yet, in times of inflation, geopolitical risk, and monetary overreach, gold quietly outperforms. It is the asset of last resort, and for many sovereign actors, increasingly the asset of first preference. First, the real yield test, gold versus Treasury bills. At the heart of this duel is a simple question: which asset better preserves real purchasing power over time? Treasury bills may yield 5% in nominal terms, but if dollar debasement runs at 6%, the real yield is negative. Gold, while offering no coupon, tends to rise in fiat terms when inflation expectations accelerate or trust in fiat regimes erodes. Over the last 25 years, especially post-2008 and post-2020, gold has consistently outperformed cash and short-duration treasuries in real terms, even more so for holders in non-dollar jurisdictions experiencing currency depreciation. For central banks managing reserves, not just for return but for sovereignty, this matters. Second, the sanction-proof asset. In a world increasingly shaped by weaponized finance, gold has another critical trait. It is immune to sanctions, freezes, or regulatory blacklisting if held properly. After the U.S. froze Russian foreign reserves in 2022, a message was sent: your treasuries are safe until they're not. This triggered a subtle strategic shift. Countries like China, Turkey, India, and Brazil accelerated gold accumulation. Global central banks became net gold buyers for 13 consecutive years, a trend now accelerating. Vaults in neutral jurisdictions like Switzerland, Singapore, and the UAE have become critical geopolitical assets. Gold is the anti-dollar not because it opposes the currency, but because it exists outside the system that governs it. Third, programmable dollars versus sovereign immunity. As stablecoins rise and Treasury bills become their default reserve asset, programmability becomes power. Treasury-backed stablecoins may provide liquidity, but they also carry built-in compliance rails, potential surveillance, and censorship capabilities, should a regulator demand them. Gold, by contrast, cannot be seized with a keystroke. It cannot be denied by a payment API, and it cannot be frozen because of political misalignment. In an increasingly bipolar world, this matters, especially for states seeking to hedge U.S. influence while remaining financially solvent. Fourth, a quiet accumulation strategy. The most telling signal is not in rhetoric, but in reserve composition. As of 2025, the People's Bank of China has officially reported record gold reserves, though many believe the real number is far higher. The BRICS nations have floated gold-linked trade settlement mechanisms. Private vaulting services are seeing rising demand from high-net-worth individuals and state-affiliated buyers. These aren't retail moves. They are strategic repositionings. The message is simple: we'll borrow your dollars, we'll lend against your treasuries, but we're holding our gold. It is the financial version of non-alignment. As the U.S. tightens its control over global yield flows through Treasury infrastructure, gold remains the uncontrollable variable. It offers no interest, no flashy innovation, and no role in the plumbing of modern decentralized finance. But it remains the one asset no central bank can print, freeze, or politicize. In this quiet contest between engineered access and sovereign immunity, gold is not just a hedge. It is the silent judge of the system's credibility. Section 7, Conclusion. The global reserve system at a crossroads. The global financial system is not static. It evolves in layers, first through policy, then through infrastructure, and finally through incentives. What we are witnessing now is not a sudden transformation, but a structural convergence, a world where credit is created globally, but yield is increasingly monopolized by one issuer, the U.S. Treasury. This convergence is engineered. The Genius Act codifies short-term treasuries as reserve-grade digital collateral. Stablecoins offer access to those reserves without full monetary sovereignty. Swap lines and proxy institutions limit that access to a trusted few. The result is a system that is liquid, legal, and lucrative for those inside the yield perimeter. This architecture strengthens the dollar's role as functionally indispensable to global finance. But it does so by making access to yield conditional on compliance, alignment, and connectivity. And that's where the tension sharpens. Because at the same time this system is being formalized, a counter system is quietly maturing, one that does not rely on programmable access, permissioned infrastructure, or reciprocal swap arrangements. That system is anchored in gold. The choice ahead: yield versus immunity. The future of global reserves may not rest on a single asset, but on a strategic trade-off. U.S. Treasuries offer yield, liquidity, and integration, but at the cost of submission to the rules of the issuer. Gold offers no yield, no real-time liquidity, and no leverage, but it demands nothing from its holder. Institutions, sovereigns, and even decentralized protocols will increasingly face a reserve allocation dilemma. Choose treasuries and gain income with strings. Choose gold and gain neutrality without return. Neither is inherently better, but the systems they support are moving in opposite directions. Final framing: the yield magnet. What began as a regulatory update has become a gravitational field. Stablecoin issuers now orbit around Treasury bill yields. Foreign banks rotate toward proxy access and structured liquidity. Central banks rebalance behind the scenes, seeking immunity in bullion. And the Fed, once merely a lender of last resort, becomes the yield dispenser of last resort. The magnet is working, but so is the resistance. In this evolving polarity, the question is no longer whether the world trusts the dollar, but whether it accepts the conditions of access to its yield. And in that question lies the quiet rebirth of gold, not as a currency or investment, but as the last reserve of unconditional value.